Is the buy-to-let dream crumbling? We've got landlords selling up, tax increases, and regulation changes. I'm going to explore the factors that could spell absolute disaster for landlords, but also absolute opportunities. I'm going to cover 3 key areas of the market attracting the most amount of attention to determine if this is the beginning of the end for buy-to-let. If you're new to my channel, hi, I'm Jonathan. I've been helping property investors secure limited company mortgages at my mortgage brokerage, SPV Mortgages, for the last 6 years. And my channel is all about sharing everything that I learned from working with them with you. Now let's get started. Stricter regulation is on its way. We've got the end of Section 21, we've got the Decent Home Standard, and we've got the Landlords Portal. That's just to name a few of the changes which potentially are coming our way in 2025. The question that I want to answer though is, will these changes actually increase the value of property investment businesses? With regulated businesses, there are obviously barriers to entry because they're regulated, and there will be ongoing monitoring as well. But as this regulation starts to take effect, will it mean that old blood, so landlords that perhaps don't have the cash to modernize their properties or just can't be bothered, exit the market, and new blood obviously enters? Does that then create an opportunity for new blood to take on existing rental properties that perhaps don't comply at a discount? So that's one thing to keep in mind. But what I'm also thinking is, if you own a property portfolio which meets all of the regulatory standards, is performing well or above expectations, does that then mean long term the value of that business is going to be much higher than the value of, say, a portfolio which is non-compliant? If you own a number of properties in a portfolio that adhere to the standards, that have long-standing tenants, that are of a good condition, does that then mean those properties are going to be more valuable than properties that don't? And does that then mean that portfolios or landlords who have taken the time to vet their tenants, who have invested in their properties are energy efficient, they're good quality homes, decent, will create more wealth long-term than landlords who perhaps don't have the cash to modernize their properties and bring them up to standard, or perhaps those landlords that simply just ignore the regulation? So this is what I see happening in the marketplace. For investors who are smart, they don't over leverage, they don't overspend, they invest in their properties, they invest in their tenants, they build those long-term relationships, they treat their tenants fairly, I think stand more to gain than those investors who don't. Right, let's move on to tax. So good news is that capital gains tax hasn't changed. But does that really matter? Because most of us are looking to invest, none of us are looking to sell. The pain is going to come from stamp duty. Now, stamp duty increased 2%, which is a little bit painful. It's going to be increasing again in April of 2025. Now, the way I look at stamp duty, the way I look at acquisition costs is, okay, acquisition costs now have increased from here to here, which then means that all you need to do is just hold the property a little bit longer in order for the capital appreciation to cover the additional cost of purchasing the property in the first place. Now, for most investors, they're going to be holding their properties long term. So I don't see it being too much of an issue, especially since regulation is going to be put into place. It's going to create this opportunity for those who have money to enter the space, and obviously those who don't have money won't enter into the space. Now, we do know obviously there is a huge demand in certain geographical areas for private rented accommodation, and that isn't going to change anytime soon. And the reason being is it's incredibly difficult to get a residential mortgage, especially if you are a young family, because as soon as you start adding dependents in and a little bit of credit, the amount that you can borrow is significantly reduced. So moving forward, yes, there is a bit of a tax burden that we now need to absorb. We can absorb that through holding the properties a little bit longer, but in reality, the best news is that if you own a property via an SPV, so a limited company, the tax side of things hasn't changed. So you can still offset all of the mortgage interest, you can offset the product fee, you can offset all the expenses via the SPV, and if you're funding the SPV via personal savings, obviously you'll have a director's loan account which you can draw down on tax-free at a later date. So all in all, yes, the tax changes have been a little bit painful for us, but at least there have been no tax changes with owning a property through a limited company. Okay, let's talk about market conditions. Now, we're all investing to build long-term wealth. Now, we do that not via rental income. We do that via capital appreciation. So we've got to look at interest rates, because interest rates affect asset prices. Interest rates are directly correlated to inflation. Now, the good news is obviously inflation is trending downwards, which means also that interest rates will be trending downwards. Now, as interest rates start to drop, house prices will start to increase, which is fantastic if you're looking to get into the market relatively soon. Now, keep in mind, of course, if you're on the sidelines and you're thinking, oh, interest rates are a little bit too high, I'm going to wait, you could find yourself priced out of the marketplace. But the good news is everything is now trending downwards, which is perfect for asset prices to increase. Mortgage lenders entering into the space has been phenomenal this year. We've had like 4 new entrants already, and in 2025 we're going to see more lenders entering into the limited company space as well. Now, I have meetings with lenders almost on a weekly basis at my office, and they're all telling me the same thing. They're looking at the limited company space in a lot of detail, which means it's only a matter of time before the bigger players get into the space. And what I mean by bigger players, the HSBCs of the world, perhaps the Barclays, perhaps the Santanders. The only reason that they haven't entered the space is because their systems just won't allow limited company transactions because they are more technical. But they are seriously looking at the space, and I think moving forwards, the number of lenders operating within the limited company space is going to grow exponentially. That then means that with more competition, pricing for products will start to come down, which then means the net profit figures that are generated from your property businesses will start to increase. Here's a question for you. Why are higher rate and additional rate taxpayers and business owners using companies to invest in property?